Okay, Clorox, CLX on New York, released earnings late last week. The mixed report for sure. Shares were down. Market was down in general, and a lot of reports were coming out beating and still going down. In this case, they missed the top line, beat the bottom line. Shares were down. There's a lot going on here actually, but we can sort through it, and you'll see long term, it just looks like an opportunity to me. So quickly, the report revenue was basically flat, but that was a miss of 4.8%. Earnings were down 14%, and that was a beat of 9.3%. Now, earnings being down 14%, it might be a bit of an alarm, but just remind yourself that this time last year was the first real COVID quarter, and they did really well because of disinfectants that people were buying, and it was just a tough comparable for year over year. So that shouldn't bother anyone. Now, they did say costs were a bit higher, so that's a bit of an issue. We're hearing inflation over and over, and they are going to raise prices going forward. So, some of the gross margins were a little bit lower than maybe expected, and I could see that as being a little bit of a concern, but I really don't think it's something you should get too hung up on. They can raise prices. They do have some pricing power, and you'll just see long term. In fact, let's just jump right in. And here's the long term view of Clorox. This is a 20-year chart, return on invested capital. You're not going to get a better picture than that, right? Basically, the worst they ever did was 18% in 2012, and it just started creeping back up year over year. Spiked a little this last year because of the pandemic, 24%. So maybe they don't totally maintain a 24% return, but I mean, you wouldn't want to go less than 18, that's for sure. Super consistent, super high quality company. What else do I want to say? They're actually doing a little bit more business than they were before the pandemic. So let's call this quarter back to normal. It's not quite there, but for Clorox, let's call it back to normal. Tight margins, but they're going to raise their prices. So let's call margins a wash going forward. You're still going to get this 20% return on invested capital. You'll see we do have a fair value, but we're putting in a fade into our model. That's just kind of a default algorithm. Let's say instead of fading at 8%, let's use 6. So slower decay of that excess return, and that'll jump up the valuation to 244. So you see these things are sensitive. That's why it's so hard to price stocks, so dependent on the future and those assumptions. But we know this. It's a high quality company. Shares have been down on their earnings, and not only were they down on their earnings, the shares peaked 6 months ago. So I think that's actually really fascinating, because 6 months ago they still would have been doing really well, in the midst of the pandemic. But the market is really good at getting ahead of things, right? And now I just think they kind of overdid it, and it just looks like an opportunity. One last thing to close this little segment here. Some interesting products here. It's mostly cleaning is what you think of, and we highlight the disinfectant. But a couple of products that I thought were a little unusual is the Kingsford coal, like for barbecues. Didn't seem to fit with cleaning, but okay. And this one, it's hard to see in there, but ranch, Hidden Valley Ranch dressing. I'm not sure how that's a fit. If I were running this business, I'd look at selling off my Kingsford coal and my Hidden Valley Ranch and just keep cleaning. But hey, that's not me. I'm not running it. Regardless, this is a high quality company that you got to take a look at. Oh, by the way, 2.3% dividend yield, and they've raised that dividend every single year for the last 20 years, probably more. We just have 20 years of data, and I think it's actually raised that dividend for longer than that.